Vested Agents presents Real Estate Action Live.
Yes.
We're going to do something different. Multiple guests answering a single question.
This will be a fun, fast-paced hour with amazing guests.
And that is how you're going to win all day, is to empower your people.
Too many agents are trying to figure out, well, how do I get my buyers' offers accepted? It's easy. Offer the highest price. It's not rocket science.
When you're a realtor or you're doing something in real estate, you have to flip the view of what you're looking at, and you start looking at what other people are doing.
So it's really just personality based, and then having people learn the ropes in an effective way.
Focus on just being there for people and providing value.
I don't regret what I did because it really made me hustle and work hard.
Better than we've ever been. We just had our first six-figure month. That's 70K just jumped to six figures.
I'm all about like building up your knowledge base, building up your mind, building up your spirit, and just slay the day.
We're always looking for people to come along and help us with our journey as well. We can also contribute and help them develop their skills.
Thanks for having me. This is super cool.
Yeah, great. No, it's been awesome.
It's an honor to be here. I appreciate you guys.
Awesome. Thanks for having me.
Hi, Haley. Thank you. Good stuff.
Chris, I'm so honored to spend time with you live, teaching thousands of real estate agents how to build their brand and not be a commodity.
What's going on? Welcome to another Real Estate Hacking Live. It feels like it's been forever. Took a little break over the summer. Had a ton of stuff going on, and we're back. A lot's changed in the real estate market, and I want to make sure that for this episode that we make sure we tackle those questions. I see it in the chat. I see it in the threads and on Facebook and LinkedIn and on Twitter. And there's a lot of opinions on all the extremes and everything in between with what's going on, what's coming ahead in real estate. And that's going to be the question that we're going to ask today. I'm your lovely host, Chris Bounds, and I've got my co-host here, Ben Deal. How you doing, Ben?
Doing great. Excited to be here.
Well, these are really fast. We got 6 real estate professionals that we're going to be bringing up. A couple repeat guests that I know they're going to have a lot of insight on this particular topic, and we got some new folks too. So since it's very fast paced, let's go ahead and break up our first guest.
Absolutely. Excited to bring Tarek Moussa to the call. Tarek is a former BlackRock employee. He's the current director of investor relations with Disrupt Equity. His focus is on capital raising for multifamily acquisitions throughout the company. Tarek, welcome. Excited to hear what your thoughts are on our question this week.
Yeah, hey guys, thanks for having me. Great to be back.
What's going on, Tarek?
Not too much. How are you guys?
Good. We've had some conversations about this offline, and I know you're out there, like you're moving pretty swiftly in the market right now, and you've got your hands on a lot of existing inventory, buying new inventory. So, what do you think? What does the real estate market look like for you from what you're seeing, boots on the ground, over let's say maybe the next 12 months, and then you can even expand it out over the next maybe 24, 36 months?
Oh, that's a tough one. I think on our side, we focus on multifamily, obviously, right? But I think it's no surprise that interest rates are moving a lot these days and obviously going upward. But the question is ultimately, what is likely to come in the future? Not to put a prediction out there, but I guess it's our expectation that given the political environment and what's to come with the elections and so on, we think that, yes, things probably will increase, but it'll continue to increase at a decreasing rate, or it may actually come back down for a time. Is that going to be the case over the long term? Probably not as much, but I think there is a period where we may see some easing of the interest rates, which ultimately opens the market up a little more and makes it a little more affordable with better returns and so on out there.
So when you're saying increase, and then further defining that as increasing at a decreasing rate, are you referring to pricing and rent, or both, or what?
Actually, I was talking about more so on the interest rate side, so on the financing. Okay. So ultimately, what does that do? That just means that when interest rates obviously are higher, that means that our debt payments are higher, which means there's a lower return on our profitability, technically, right?
Yeah, 100%. So how are you thinking that's going to impact from a multifamily standpoint? How's that going to impact pricing, rent, and of course, going forward, what's buyers' appetite for that?
Yeah. Well, as interest rates increase, that means that people can pay less for the property or for the usually the property, frankly, from the ownership side of things.
The returns going down, right?
What's that?
Because the returns going down, assuming
Exactly.
all else equal.
The returns go down, the amount of leverage you can get for the bank is going to be lower, and so on. So it's just multifaceted, but ultimately it just reduces the price point that you can actually offer on these deals. So ultimately, what does that mean for us? I think that you're going to find that more people out there, tenants, renters, if you will, who once upon a time would be looking to buy a home, it's going to be more challenging for them to also be able to afford their own property, which means they're likely going to be looking for a place to stay, which obviously bodes well for our business because ultimately we provide housing for folks.
Okay, so dissecting a couple of things there. On the single family homeowner side. So what you're saying there, and you're focused on multifamily, but because more of them may be priced out of the market because of higher cost to buy, there's going to be more renters. Now that's good for multifamily landlords, just anyone in that space. Now on the seller side for multifamily, how has it been? How have they adjusted in over the last few months with these rising rates? Are they more sticking to the notion that everything's going up and they're expecting that shoot to the moon price, or are they being a little bit more flexible now?
Yeah, I think at the beginning of the time that the interest rates started changing, they were all still aiming for the moon and hoping to get as much as they could out of this, but they've had to temper their expectations and be more realistic and understand that, hey, things aren't as they were. And what the challenge is, it's not a problem on our side, but it's more so a problem on their side, where ultimately, whenever you buy these deals, you want to be pretty conservative what you expect on the outcome, right? Don't want to be overly aggressive just because you don't know what's going to happen. And in this case, those who got overly aggressive and assumed that the rising rates, the rising prices were going to continue indefinitely, they're now in for a big surprise. And thankfully, there's usually a broker intermediary between the buyer and the seller. So the brokers have had to kind of set the sellers' expectations and put them back to reality to show them that, hey, you're going to have to take a price cut and be more realistic. Otherwise, you can hold on to the deal indefinitely. But in most cases, a lot of these folks, at least the size of the deals that we play with, that we work in, they tend to have a timeline to when they need to exit the deal. So if they want to sell the deal, they have to put in a price point that's going to be competitive. And that price point these days is lower than they may or may not have initially expected.
All right. So, and you had talked about growth, but more slowing of growth. I think when a lot of folks out there, they're saying, hey, prices are going to fall, they're not necessarily thinking of slowed growth. They're thinking of negative growth, i.e. 2008 to 2010. Is there any type of scenario, do you think that potentially could happen here over the next couple of years, or?
Good question. My personal opinion is that it's unlikely. I think what you find is that real estate is unlike other asset classes in that real estate is extremely resilient with its pricing, right? Over the past century, how many times have real estate actually fallen? Once, 2008, really? That's pretty much it. But throughout that 100-year period, there have been interest rates that have gone up, down, very high, even to nearly 20%, and prices still increased during that period, right? So that tells you that interest rates aren't necessarily the deciding factor. There's other market fundamental variables that are playing a role here. And what my belief is ultimately is that right now you have the insufficient supply of real estate to match the demand that exists. So ultimately, supply and demand really drives everything. So in this case, I find it unlikely that prices are going to come down. Like I said, I think it's likely to increase, but maybe slower for a period of time, but eventually it will continue on upwards. Ultimately, even if you want to talk about 2008, that anomaly that existed, it depends on what time period you look at. Ultimately, the nice thing about real estate is if you wait, typically you're going to do okay on the return side, because even 2008, if you bought in 2008, then in 2009, you look like a dummy. In 2009, you still look pretty dumb. By 2012, 2013, 2015, you look like a genius again. So ultimately, what is your timeline? Make sure you enter pretty conservatively. And then if you don't like it, wait a little, be patient. And over the long run, it's hard to go wrong with real estate.
Are you finding investors, so in multifamily, bringing on equity partners and third-party investors, it's a lot more common than, say, single family. Are you finding that they're being a little bit more cautious in their approach with new opportunities and expectations?
I think the answer is definitely yes. I think if I had to put a number on this, I would say that we're probably having to work about 5 times as hard to get the same amount of capital. And that said, we're obviously growing with our size deals. We've raised $100 million over the past, roughly 120 days or so. So definitely a lot of money.
Major congrats there. I mean, that's huge.
Thank you. Yeah, hopefully that's the start of a lot more to come. But that said, it is requiring a lot more work on our side. A year ago, there was a lot of money flowing everywhere. Everyone's got more money they know what to do with. So that was a lot easier to have these conversations. But we're having to, 5x that amount now just to get an equal rate in return. But what you find is, realistically, interest rates have been changing. Nobody knows what's to come next. There's a lot of fear, uncertainty, and doubt out there of what's to come next. So people are kind of sitting on the sidelines, sitting on their hands. But realistically, when you look back in time, right, I think history is probably one of the best teachers of what's to come in the future. And you find that ultimately, turbulent times in the market are when the greatest fortunes in history have ever been made. So on our side, we're being conservative with our criteria and our underwriting, make sure that whatever deals we get into, we're buying them right and we're buying them very carefully. But once we find this deal that is great and worth going after, we're making sure to let our investors know that, hey, this is the time where it makes sense, and making sure and explaining to them, right? It's not just telling them. Of course, there's always going to be some bias in how they perceive us ultimately. But the reality is, our goal is not to push them and say, hey, invest in the deal. The reality is, here is all the information that you need to make a decision. If you want to participate, here's why it makes sense. If you don't, that's totally cool too. We're not here to push you. We're not used car salesmen at the end of the day. But if you're looking to get a really good return on your capital and your investment, then here's why this could make sense for you. And even on the interest rate side of things, right? We're still seeing great rates that we can achieve just because of our track record of relationships and so on. We just got quoted on a deal at 3.5% interest rate. Awesome. You don't see that these days. But this is part of the benefit of what we can provide for people versus what they may be able to get on their own deals or with other folks out there. So there's a lot of uncertainty, but ultimately they know that if you have a track record of success and you've been diligent in the criteria, and we share everything, we're pretty transparent at the end of the day, where let them do their own due diligence and make sure that what we're telling them aligns with what they expect and how they interpret things. And if all is alignment, everybody is in agreement and makes sense, then we'd be happy to work together and ultimately see what we can get them for a return on the deal.
Love it. Love it. Yeah. It's building relationships and educating.
That's all it is. It's all about adding value and educating for sure.
Love it. Well, thank you very much, Tarek. Appreciated seeing you out at the y'all's event last week. Look forward to coming out to the next one. So thanks again.
Always a great time. Take care, guys. Cheers.
Okay. All right, Ben. Who's our next guest? Uh-oh.
Jay is an entrepreneur, investor, advisor, author of a best-selling book, The Book on Flipping Houses, and partner in Bar Down Investments. In the past 14 years, Jay has been involved in more than $150 million in real estate. He also holds strategic advisor roles in several companies. We are excited to welcome Jay Scott to Real Estate Hacking Live.
What's going on, Jay?
Hey, how's it going, Chris?
Good. Yeah, I mean, you're one of the folks out there that anytime you post something, I can expect two things. One, it's going to be ridiculously long, but two, it's going to be ridiculously valuable to actually finish it because it's so content rich and fairly, at least from my perspective, balanced as opposed to pushing a specific viewpoint. So I've always appreciated that, and I think folks will probably get some value out of this here. What are your thoughts going forward in the real estate market? Are we looking at a 2008 type scenario, which is one extreme, or is the music going to keep on playing loud and clear?
Yeah, so let me start with, I don't have a crystal ball. Nobody has a crystal ball. So anything I say, I could be wrong. I've been wrong plenty, and I'll be wrong plenty more in the future. So I can make my best guess. I can look at the data. First, I think we need to consider that when we talk about real estate, we're talking about, well, at least two things. We're talking about residential, single-family residential, or small residential. We're also talking about commercial. And I think it's important to make the distinction between the two because the way the thing we care about is values. I mean, obviously, as landlords, we care about rents as well, and we can talk about that separately. But when we talk about where's the market headed, in general, we're talking about where are values headed. And so when you're talking about values, the way we value residential, single family, and small multifamily deals is completely different than how we value larger multifamily or commercial deals. And so on the single family side, things are based on comps. If I live in a 2-story house that was built in 1995, that 3-bedroom, 2-bath, the value of that house is essentially going to be related to what did the last several 3-bedroom, 2-bath, 2-story houses built in the 90s sell for in my area. And so it doesn't matter whether I'm renting my house. It doesn't matter whether I'm renting out my house. It doesn't matter whether I own it, whatever. The value of my house is strictly based on what the other houses around me are doing. On the other hand, for commercial real estate, larger multifamily real estate, everything's based on income. It doesn't matter what the apartment complex down the street sold for. It doesn't matter what the self-storage facility next to me sold for. All that matters is how much income I'm generating, and also this thing called the cap rate, which is basically a multiplier in my area. And so typically, we're going to look at these two things very differently. Let's start on the residential side. So on the residential side, things are based again on comps, where other things are selling. What I see likely to happen over the next 6-12 months is actually not a whole lot. For the most part, Tarek made a good point that throughout history, over the last 100 years, we don't typically see real estate dropping in value. Certainly, it's happened a couple times. It happened during the Great Depression, happened during the Great Recession back in 2008. It's happened a little bit back in the late 80s, early 90s. But for the most part, it's not driven by the same cycles as the general economy. Real estate doesn't tend to go down just because we're in a recession. So that's number one. But number two, if you look at 2008 and you want to compare to 2008, in 2008, we had a foundational crisis in real estate. There was a lending crisis. There was a bond crisis. There was a crisis with sellers who were getting these adjustable rate mortgages that were coming due. There was huge unemployment, which I'm not saying we won't have that now, but right now the employment sector is looking pretty strong. And so people were getting foreclosed on and they were being forced to refi and couldn't refi because lending was getting tight. We're not seeing that these days. For the most part, a lot of sellers or a lot of potential sellers, people that own their houses, they bought over the last couple of years when interest rates have been tremendously low. Houses have been tremendously affordable up until the last year or so. A lot of them have good jobs. A lot of them are working remotely. They're working in places where they want to live. They've bought their dream houses in their dream locations. And so sellers aren't, for the most part, in a situation where they're going to be forced to sell. And that's the difference between now and 2008. In 2008, a lot of people were forced to sell because they couldn't refinance. They couldn't support their loan payments because the interest rates were a lot higher. But we're not seeing that now. So what I think we're going to see on the residential side, the single family side, is we're going to see a whole lot fewer sellers who are desperate to sell. There are always going to be some buyers. And I think the number of buyers out there who are looking to buy, interested in buying, will kind of match the number of sellers who are forced to sell. And we'll see prices that for the most part stay the same. That said, obviously there are trends that we have to follow. There's population trends, there are employment trends, there are places where businesses are moving. And so I think real estate's always location dependent, but I think over the next couple of years, it's going to be even more location dependent. There are a lot of areas where people are moving out of, again, because we've gone from 15% remote workers 2-3 years ago to over 25% remote workers now. So a whole lot of people are moving to places they want to live as opposed to where they have to live for their jobs. So we're going to see, and we have seen, a big migration from certain locations to other locations. We've seen this migration of businesses and employment from certain locations to other locations. And so what we're going to see is those places where people and businesses are leaving are going to tend to do maybe not so well. I'm not saying it's going to be a 2008 type event, but we're going to see softening. We'll probably see prices go down. We may even see rents go down for the first time in history. But then there are going to be other places where people are moving and businesses are moving. And I think those places are going to hold up really well. Do I think we're going to see continued growth over the next couple of years? Not like we've seen, maybe not at all, but I don't think we're going to see a drop in housing prices in places where people tend to be moving. So if you want to know where housing is going to do well, look at the population trends, look at the employment trends, look at places that have good employment diversity. Those places are likely to hold up. Now, then there's the commercial side of things. On the commercial side of things, it's mostly driven by two things: rent and mortgage. Other expenses obviously drive things. Inflation's high, so other expenses are going up. But rent and mortgage are the two big things. I think over the next couple of years, we're likely to see rent stay consistently strong. It's not going to grow at 5, 6, 7% like we've seen over the last couple of years, but we'll probably hit that historical growth of 2, 3%. And on the mortgage side, mortgages are likely to go up. So rates are going up. They're likely to continue going up through the end of this year. So we're going to see higher rates. And that's definitely going to tamper demand. It's certainly going to tamper values. But again, I don't think it's going to be a 2008 type event. I think for the most part, we're going to see fewer sellers who are desperate to sell or need to sell or want to sell. We're going to see fewer buyers out there. So I think we're going to look back in a year and we're going to say there's very little transaction volume, very few sales, but prices basically held up over that year.
Yeah, and that works well. We got a couple minutes left. That works well for the landlords. For transactional based, say realtors or brokers out there that are working in an environment with fewer transactions. So we had lower inventory. Can be fewer transactions, but now we have other factors that will reduce transactions. It's gonna force some folks to move into maybe spaces, maybe working more leases or referrals than they've had to do in the past. But on the commercial side, you were talking about, you got rents and debt service. The one thing that has been really good for operators is rents growing at a pretty good rate has been able to mitigate some of the debt service costs that they've had. And we'll see if that continues to trend. But ultimately, over the last 70 years, I looked this up, there was only 1 year that had negative year-over-year rent growth. Macro. Micro matters, but this is macro. And that was 2010. And I think it was only like 3 months out of 2010, and it was like 1%.
It was tremendously. If you look at it on a graph, you don't even notice it.
No. So it's promising from a macro level. Micro does matter, but it's definitely promising from a long haul. Things definitely change if you're talking about flipping short-term single family. It's a lot different there. So, all right, hey Jay, I think we need to get you on for like a full hour here. Appreciate it. If you don't follow Jay, definitely do his commentary. I don't know if you're doing it weekly or just whenever, but it's always really good on the market. So, thanks again, Jay.
Appreciate it. Thanks, Chris.
All right, Ben. Next up, yeah, man, great information. I love just the transition for remote workers and business migration. Like great information on that. So excited to bring up Jennifer Hernandez. Jennifer is a senior loan officer for Legacy Mortgage, Mutual Mortgage based in Houston, Texas. She has over 27 years of experience, 4,400 loans closed and counting, and won Houston's Mortgage Lender of the Year in 2018 and 2019. Excited to welcome Jennifer to Real Estate Hacking Live.
Hey guys.
Go on, Jennifer. How you doing?
Hey, good. Just another day in the mortgage world, making loans happen.
We're getting a little choppy feedback, so hopefully everyone can hear. You've got a unique perspective with this market because you're in the lending space, and that has been the volatile space lately with interest rates kind of being a little crazy. So what are and you focus on single family. So what are you seeing going forward right now, going forward over maybe the next 12 months, as far as where real estate market will be?
I think, and apologies for the feedback. My company computer didn't let me in StreamYard, so I had to do it on the phone. So sorry about that.
No worries, we're good.
Yeah, thank you. So I think that we're definitely seeing in buyers, we're seeing a very big gap in affordability. I talk to people every day that say they want a house of this price, but a payment way down here. So there's definitely a struggle right now between what people want to pay. I think that that's going to continue. I think that people just need to get used to either a new reality or rework their budgets. We see a lot of people that on paper, they can afford a higher payment, but that doesn't mean that that's what they want to pay, right? So I think that in general, we see lots of buyers out there. They're just trying to absorb the new reality of what payments are. We just keep everybody engaged and say, listen, y'all, rates are going to be down in a couple years. You can refinance. You marry the house, not the rate. So, you're missing out on appreciation. So
like at the end of the day, if rates were to go down, and historically within 2 to 3 years, they'll once they start increasing, they decrease, but no one has a crystal ball there. But at the end of the day, if you can afford it, it's and it's a long-term play for you, not just like a 2-year, 3-year place to live. It might be, it might make sense to go ahead and make that decision. But what percentage of folks that you've talked with and they ended up not buying a house, delaying, say January, February, how is that? And then you go talk to them this summer after interest rates started climbing. How did that impact their buying power? Did you see like a 20 or 30% drop
I mean, as far as a percentage of people that you mean a percentage of people that they're
they're looking and you're like, you're good up to 650 based on your income. But then they go in to talk to you in July and you're like, well, everything being the same, you're good at 475. Now those are numbers. I just threw out those numbers. I'm just curious what you see.
I mean it's a 10% difference in price, 10 to 15. I mean that they qualify for,
which is huge.
So it's large. Yeah, it's large. So the more on a monthly payment level, and again, each price range has a different mathematical equation to it, but there is a gap. So we're really combating that by educating, making sure people have the right information, making sure they understand that, hey, you do get, if they're going from renting to owning, remember you get a tax deduction once a year. You'll pay less income tax. Remember that your house is appreciating. So it's like you're paying more in monthly payment than you're used to. But remember you're directly contributing to a savings plan that's going to benefit you long term. So it's just helping them understand that. But there's a large percentage. I mean, everybody's payment shock. Some people can absorb it.
I imagine
more than
it
others,
impacts the first-time home buyer much more than folks that are selling. Because if you're selling, you're capturing equity and typically putting it into another home.
And you're benefiting that way. For sure.
Yeah. So, what are your thoughts on going forward, the real estate market? Like, because I'm sure because you see the transactions coming through, and like I don't know if you've seen a little bit less transaction. I mean, you're seeing both sides of transactions. You've got purchases and then you have refis. But what are you seeing trend wise there, and how do you see that playing out over the, say 24 or 36 months?
I mean, we're still seeing some backup contracts. It is not going away. It's still a seller's market. Yes, the percent of appreciation or the percent over is down, but we're still growing. So the market, it is not going backwards. There might be some isolated cases here and there where people need to sell because they bought something else and there might be some stalled markets areas around town. That's normal. But for the most part, we're seeing values as far as real estate values, they're still going up, not at a ginormous pace that they were last year, but that was not sustainable.
No,
it really was, it wasn't logical. It happened for a short period of time, and the homeowners that benefited from that are super happy about it when they're able to sell and capture that equity. But I see things continuing to rise. As far as the rates go, every day is really just so different. Just because the Fed raises the rates does not mean that our rates are going to increase. It doesn't always happen hand in hand. But I think that things are in the sixes for a period. I mean, I think anything below that is probably a gift. But again, thinking of the long term, there'll be another refi boom. I mean, it's a historic, if you look at a graph of the last 50 years of rates, every time there's a recession, the rates go down. That's how you get yourself out of a recession. So we're not there yet. The prediction is 18 to 24 months. So we'll see another refi boom. It'll happen. it'll happen. But
yeah, and you never know when the lowest. I mean, I don't know that we're going to see like the 1.8% interest rates again anytime soon.
Yeah, that wasn't realistic either. Just like 30% appreciation wasn't realistic. Neither was that.
When I bought my house, I don't remember the interest rate, but then rates went down to a historic low, and I refied because I was like, surely they'll never go below 5.5, and then they just kept falling. And at that point, I was like, it didn't make sense to refi again. And but in any case, thoughts for first-time home buyers who are iffy on whether they can afford it or maybe they're close to it. What are your thoughts? And I'll quickly share my thoughts. I was like, regardless of whether you're going to buy now, 6 months, 12 months, 18 months, go ahead and go get pre-qualified with your loan officer, because they can at least let you know what you're looking at and what that product is, what your options are, or the things, and then this is the important part, the things that you need to do that would help you get a better rate, better terms, or help you qualify. And if you don't know those things, it's hard to improve on them. So what are your thoughts for folks?
Yeah, you hit it right. You hit the nail right on the head. I mean, find out what your plan of action needs to be. I wish everyone came to me 6 to 12 months ahead of time so that we can have proper time for homework, tell them how they should pay off debt, in what way that's going to boost their score the highest. We do a simulation for people to give them a good pathway for that, and really give them real knowledge on what they need to be saving, for that time when the time comes, and what house they do qualify for, so that they can have time to rework their budget or whatever that might look like. So yeah, you hit it right there. People should just inform themselves and talk to a lender earlier than later. Definitely.
And reach out to you, right?
Yeah, sure. Loanwithjen.com. All my info is loanwithjen.com.
And you get a phenomenal YouTube channel. It's been growing. I've been watching you. So
yeah. Over 360 videos now. So I've just been doubling down on educating people. I just want to get people the right information. So if you're listening, whether you're a realtor or investor or whatever, I have videos for everybody. Loan with Jen on YouTube.
Love it. Yeah, definitely check it out. So thank you very much, Jen.
Thank you. Talk to you later.
Bye.
Absolutely. Love that. Double down on education. Next up is Sarah Sullivan. Sarah is the founder of Sugo Capital with over $260 million in assets under management. She's an expert in passive income investing and loves educating others about real estate investing. She's a contributing member to the Forbes Real Estate Council. Welcome, Sarah, to Real Estate Hacking Live.
Great to be here. Thanks for having me, Ben and Chris.
How you doing, Sarah?
I'm doing great. Thanks. Great to see you.
You too. So we first got connected. I saw you speak at I forget what the event was called. Fun Watch Live in Vegas, and actually just got back from Vegas. And then you had some roundtables, and really enjoyed your conversation. So I know you've been in the game a while. You're an operator as well as an investor in the real estate space. So I thought you'd have some unique perspective here. Where do you think the real estate market is going? And you can break it out over, because obviously the next 12 months, that's one viewpoint, but also in multifamily, which you're in, long term is pretty important. So like the next 3 to 5 years.
Yes, I think that's a great question. And that's the number one question I'm getting right now is, what is the real estate market going to do in the next 12 months to 5 years? And the thing is, in the US, there's not a real estate market, right? And you know this, and I want to make sure everyone listening knows this. There's not a real estate market in the United States. So different kinds of real estate are in different stages of the market cycle. So single family home cycles are not the same as multifamily real estate cycles, are not the same as, commercial mixed use. Right. So everything has a different cycle where it's a good time to buy or a good time to sell or a good time to hold. And so I want everyone to think about this because, I've learned about all different kinds of real estate investing so that when it's the right time to do this asset class, I can do that asset class. When it's the right time to do this other thing, I can do that other thing. And I also want to call out that each location in the United States is really different. And so, for instance, when the real estate market in Houston is doing something, the real estate market in San Francisco is doing something else, and they're not doing the same thing. So for instance, Phoenix, we all know what was going on in Phoenix. If you're a real estate investor over the last couple of years, it was like the place to be, the hot market. Like everyone was just screaming to get in there. And now the reports are coming out that it's like, it's the number one place for rental decline in the United States, these sort of things. While Houston, the rental rates are going up 12, 16% per year. So Phoenix and Houston not doing the same thing. So it's really important when you're an investor. So it's really different from, the last person you had who was speaking about when you're buying your home, you're spending money on real estate because of you personally, your emotions, where you want to live. When you're investing, it should be totally not correlated with where you want to live.
That's the best part of it.
Yeah, you don't have to live there if it's investment property, whether it's an Airbnb or a single family home rental that you have, or duplexes, or if you're in something passive like a REIT or a multifamily syndication, which is what I do. Those are 100% passive. So it doesn't matter where they are. Someone else is operating it for you. And so you're going to want to look at the markets that are still performing really strong, given what's going on in the rest of the United States, right? So there's data you can look at that's relative data, and then there's absolute data. So like unemployment rate, you're going to want to look at relative data. What's the unemployment rate in Houston versus the rest of the United States? That tells you where people are going, where the jobs are going. And so supply is going up, but not as fast as demand is going up. So that's a great place to have product. So I love that question, because it's like I could talk for an hour on what's the real estate market doing, because each city, each MSA is really different. And so I live in California. I live in San Francisco. I will not buy investment property in California, but I'm all over Texas. I'm all over Alabama. I'm all over the Carolinas. There's other really great markets, and so you got to look at all that kind of stuff, and you look at job trends to know which is really influenced by local government and incentives that they're giving and those sort of things, in order to see where people are migrating to. And especially right now, migration happens really fast, right? So we saw that in moving companies put out this data, like what's number one ingress, number one egress cities. So you can see, okay, number one place everyone's moving to, number one place everyone's leaving. So you know where to buy and sell.
Yeah, and two interesting facts there is the long-term trend of like 2010 to 2020 was away from the coasts, more to the Sun Belt area and mountain region. But then a 1 year time period from 2020 to 2021, it's like everything 10x. And if you look at the macro, like West, it lost residents. It was like a negative, I think it was like 144,000 or so.
Exactly.
But if you peel off the West Coast and leave the mountain region, they gained like 200,000 residents. And I'm sure it's a lot of folks moving from California to Nevada, Utah, or whatever. It's close enough to good weather, and maybe a little bit better on the lifestyle or something. But yeah, it definitely matters. Have you followed new constructions? It seems to me when we're low inventory, demand is softening a little bit, but still high. And that's just because of interest rates. But ultimately, we still have really, really low inventory. And the one thing that I've noticed lately is single family construction has pulled back hard, but multifamily construction way behind still, but picking up steam. They're at a 50-year high. Now that's, I don't know if that's good or bad, because we need more housing. But I don't know if you looked at that or if you follow that trend.
Yes, so we always look at that. So for instance, we bought some property in Huntsville, Alabama. And so you can just call the local government and say, how many units have you approved to come on market in which timeframes? And so they had a period of time where they were not allowing new builds on the apartment buildings. So we bought there because we're like, it's one of the number one places of job growth, and the local government has not approved any new builds.
Yeah,
so
no new competition.
Yeah, right. Even if you buy something that's not that great, which is what we bought, it's like the demand, and we're going to make it better, right? But the demand is so strong for it, and that creates a larger area of demand because people are going to commute in. But so now they approved new housing projects. So stuff is going to come online, but then we watch, when is it going to come online? Because it takes a while to build a 200-unit apartment building. So sometimes it takes about 2 years, and then you lease it up. It takes maybe 6 to 8 months to fully lease it up, get 200 families in there, and then about 2 years to stabilize it before you're going to sell it again. So when we're going into markets, we look at how many of those are going on in the area. So for instance, the corridor between Austin and San Antonio, 2 years ago, we were going to buy there. And then we looked at the number of new construction approved, and we're like, new construction is going to take over. And our sweet spot is buying existing apartments and making them nicer. So we didn't buy there, even though it's a great place for development for what we do. We were going to be competing with new stuff in, a matter of months. So we didn't buy there. So yes, I'm always looking at that when we're deciding where to buy. It's really important because it's simple supply and demand.
100%. I would imagine on a small scale, small term, some new inventory even helps existing units because you're bringing in Class A, which some of them won't necessarily rent at Class A because you're bringing in people.
Yes.
But some of that will spill down. But yeah, I mean, there's an absorption rate that has to be factored in, and
Yes.
that trickles down.
Yes.
We got maybe 60 seconds here. Any other final thoughts on what's ahead for real estate or multifamily specifically?
Yeah. So everyone knows this. When you make money in real estate, it's on the buy. You want to buy low, sell high, right? And so even though you get cash flow on investment properties, you get most of it from capital gains. And so a lot of people are afraid to buy right now because prices are going down. But when prices are going down, that's when you want to buy. So even though interest rates are going up, we're negotiating price down and making purchases because it's going to shift in the future. With inflation, rent's going to go up. Those capital gains are going to be really strong on commercial real estate and especially in multifamily. So just keep that in mind. When prices go down, it's a good time to buy, which is what we're doing right now.
Yeah, and operators that they're doing proper due diligence and putting the risk tolerances in there. In the event that 2 years from now interest rates were to fall, that's a potential little extra like mini windfall that they can enjoy. But you've got to be careful there.
Yeah. Yeah.
Well, thank you so much. It was a pleasure having you. I look forward to talking with you again soon.
Awesome. Thanks for having me, Chris. Nice to meet you, everyone listening.
All right. Yeah. Love that little topic around trends and following those trends in those markets. Super valuable. So next up, we've got Tom Berry. Tom is a real estate investor and serial entrepreneur. He is partner and CEO of Investor Loan Source, providing asset-based lending to fellow real estate investors nationwide. His holdings include commercial real estate, lending company, private equity, a meat plant, and others. Welcome, Tom, to Real Estate Hacking Live.
Tom, I knew you did a lot of stuff. I didn't know anything about the meat, your meat business. I don't know if you know, like I don't think I've ever bought, maybe one time I've ever bought meat at a grocery store. Like I've been blessed, family get good stuff from the family, and that's interesting. I don't know, maybe we ought to have a steak together.
Let's do it.
So real estate, you've got your finger on the pulse, both as an active investor, very experienced there, but also with the other businesses, especially in the lending space, working with investors. So what are your thoughts going forward? And also, you've been in this business for a while. You've seen different market cycles. But what are your thoughts going forward over the next 24 or 12 months or so?
Yeah, I mean, I've been waiting for this time for quite some time. We bought a lot of stuff back in the last recession, and on the tail side of that recession. And then, I just kind of went on a hiatus and we didn't really buy a lot of real estate for quite some time because prices just continued to inflate. But now, I'm getting excited again. I'm retooling. We're hiring new people. We're taking extra office space because I see an opportunity coming, and I definitely am in a different position this time than I was last time. So we want to capitalize, so to speak, on it.
Yeah. Now, is that because you're seeing a potential for decreased year-over-year prices or decreased demand, because some investors are going to be sitting it out? They're waiting for the 2008, and the fact that they're not buying means you have less competition. You can go in and you can get some pretty good deals.
Right. I mean, I just look at everything on the commercial side on a cap rate basis, and we're starting to see cap rates slowly rise. Is it huge? No, but we're seeing it. We're getting things under contract. We're making purchases where in the years past we've just not been able to buy at that particular buy box, and our box hasn't changed. Our criteria for buying hasn't changed. The market has. So as those opportunities are now presenting themselves, albeit on a very, very slow scale right now, I believe with what we see in the economy and what we see in interest rates and what we see in a number of other things that I watch, I think that's going to accelerate. And I think it's going to accelerate greatly over the next, honestly, I think it's going to accelerate greatly over the next 9 months. And I think it will remain a real buyer's market in the commercial real estate space for an extended period of time, maybe even longer than typical.
Just so folks can have some perspective there, commercial, are we referring to office, industrial, self-storage, or multifamily? I guess is more from a lending standpoint, it's commercial.
Yeah, well, all of the above. I focus myself on retail space and on industrial. That's my focus. Now, in the last cycle, our focus was on multifamily. So I've been there, done that, and don't want to go back to that again. We're going to be doing a little bit less management intensive asset classes going forward. But honestly, like your last speaker, Sarah, had mentioned, everything cycles at different times, right? So I think the time is right now for office. And we've picked up a couple of those. And I think it's getting right for retail, and it's going to be real right for retail here pretty directly.
Yeah, you're the first person that I've heard mention office, and that doesn't mean anything because I just don't hang around a lot of office investors. What are you seeing in the office space? Because office was disproportionately hit hard with COVID.
Sure.
And we've got recession clouds kind of looming, which may cause folks to pull back in that. But what are your thoughts there? What are you seeing?
Well, we're seeing prices depressed in office. I can buy a real strong cap rate pretty much anywhere in the country right now on a nice office building. Now, I'm talking about office buildings of a size of say 50,000 to 150,000 square foot. In that size, you're seeing, things that are 30% occupied to 80% occupied, and most of them closer to the 30 to 50 range.
Yeah.
There is a lot of issues in the office space. Now, we've got a 74,000 square foot building in the energy corridor of Houston. That is a really hard hit submarket for office. That submarket is sitting somewhere in the low 70s for occupancy rate, but our building is somewhere in the high 80s. And I think by the end of the year, with all of the conversations we have going with various tenants, I think we'll be back to 100 again, which is where we've been for the last year and a half. So like your last speaker talked about, things cycle differently depending on asset class and geography. As far as, Houston and San Francisco aren't going to do the same thing at the same time. We could also take that down to the micro level of submarket as well, in, let's say, a Houston or a San Francisco. And then we can take it down even further to building to building. They're not going to do the same thing. The way they are managed, the way they are handled, the way they're maintained, the way they are leased, advertise. All of those things have an effect. So I think that lends itself to why you can see a particular building in a hard hit submarket still excel and do real well.
Yeah, I mean, ultimately, as long as you're knowing how to underwrite, you've got your stress test performed and good upside wins ahead, and you're planning long term. It's definitely very smart. Say like maybe switching to the residential side, because on the from a lending perspective, you've got a good pulse on that market, and maybe let's focus on the single family. Where are you seeing that over, say, the next 3 years? So this is macro. Next 3 years, you work with a lot of house flippers, also landlords. I'm sure a lot more landlords these days than house flippers. But where are you seeing that market?
Well, I think, well, first of all, let me say I don't have a crystal ball, so I can't see 3 years out. I don't think anybody can. If I were to just guess, and I think at that point, that's what anybody's doing, I would say that single family is still going to be a real strong market in the places that people are moving to. Again, I hate to keep going back to Sarah, but dang, she was spot on with everything she said, because you want to be where people are moving to. So,
get in the way of progress.
Yeah, you want to get in the path of progress. And so I think a Houston, a Dallas, pretty much anywhere in Texas, Florida, except for some of the places that have really, really just grown exponentially, like Miami and some of the other larger cities over there. Those places, we're going to be good. We're going to be good over the next 3 years. There is still a lack of housing in this country. Now, I would argue, a lot of people say, well, housing prices can't come down because of the supply and demand. I would argue against that. I think I'd have a good argument against that philosophy. I think the people that are thinking that way are not going to be hedging enough, and they may get crushed in this looming recession, because the media drives demand. And when you have the media with every single article talking about how real estate is crumbling, real estate is falling, real estate is crashing, that will drive demand up that fast. And you'll start seeing people combine households again, just like we did in 2008 and 2009. All of a sudden, all that demand that we thought we had disappears. It doesn't go away. It just disappears for a while. It'll disappear until the crisis is over, until the recession is over. Then those people want to move away from mom and dad again, or mom and dad want to get away from the kids and grandkids again. And all of a sudden, we'll have new house formations again.
Love it. Love it. Well, thank you so much. These are quick, and I think we need to have you. We haven't had you on the long form part of the podcast as well. So definitely need to make sure that happens. Otherwise, I look forward to seeing you at one of these local events soon.
All right. Take care, Chris.
Take care, Tom. Thanks.
Yeah, some great gems on that one. Demand does not go away, and see the opportunity coming. So great stuff with Tom Barry. Next, excited to welcome Percy Nikora. Percy is the co-founder and managing partner at Penn Capital, a vertically integrated multifamily investment company. He has been investing in real estate for the past 20 years with an emphasis on multifamily over the past 10. Welcome, Percy Nikora, to Real Estate Hacking Live.
Thanks, guys. Thanks for having me. Excuse the hat, because I figured I need something to keep the glare from the camera. So I hope that's okay.
No, you're good. I had someone comment on my receding hairline. I'm like, yeah, it's been receding, but I've seen my grandpa had decent hair, so I'm hopeful. Anyway, you've got a depth of experience in the real estate space, just in general, but also multifamily over the last 10 years. What are your thoughts going forward? Because you're underwriting deals now, you've got deals in inventory. Going forward, like now, you get a good opportunity. You're underwriting. What are some of the main things that you're looking for to help you plan accordingly over the next, say, 3 years?
Sure. So first off, I think a lot of the points made by your previous guests, Sarah and Tom, as well as Jay, they were right on, right? So a lot of it depends on sort of the local markets, and we specialize in secondary markets that have really good job growth and population growth. I'm glad to hear that Sarah is bullish on Huntsville, because we are really bullish on Huntsville as well. We have somewhere around 1,400 units in the Huntsville area. So to answer your question in terms of what have we noticed and what are we doing differently, obviously interest rates are up. So during our underwriting, we are projecting higher interest rates, right, during the whole period, as well as during the exit. So if the next buyer comes in, to make sure that it still makes sense. We always used to increase our exit cap rate, which means we used to account for some weakening of the market. And now we're increasing that exit cap rate even more, just to be conservative. And then the last thing that we do is, we also make sure that we look at this ratio of affordability, if you will. So we look at markets that have a relatively low cost of living, but high income. So we want to make sure that the rent is not going to cost somebody more than, let's say, 30% of their income. And that's one of the reasons why we like Huntsville and some of these other markets, as opposed to other gateway cities like Miami, Phoenix, even Houston. We've actually sold some of our assets in Houston because we like the macroeconomics, or I should say, more sort of local macroeconomics in that particular MSA, like Huntsville, better.
Mm-hmm. Awesome. For affordability, I don't know if you've looked at this. So you've got experience with single family as well as multifamily. So one thing that it's been rolling around in my head. So we have low inventory, and that's been driving prices, and there's really no end in sight right now. Like there's really not any single factor that suggests that's going to change. They're just not building enough. However, I've heard this argument that we actually don't have a low inventory problem. We actually have plenty of inventory. It's just investors own a crap ton of it. So to me, it's always been that, I don't know, that black swan event that could maybe sometimes or somewhere down the future. Is there ever a situation or anything, any reason why you would see maybe a surge in inventory because some of these investors, whether they're regional investors like us or more institutional folks, decide to offload at a faster rate than acquisitions?
Yeah, I mean, I don't want to comment too much on single family, but I'll say in the markets that we operate, we're still seeing a huge backlog of construction. For example, a lot of the assets we own are sort of core plus assets where people can afford, these folks are making six figures income. They can afford a house, but there's a 18 to 24 month waiting list in order to get the home built. So for that amount of time, at least, they stay in our apartments. And our most common reason for people not renewing the lease is, after 24 months or so, their house is not ready and they're ready to move. Actually, what we're seeing right now, believe it or not, is that with the interest rates going up, some people are having challenges getting financing for their single family houses. And some of the builders are even cutting back on spec houses, if you will. So I think that's going to impact the demand for apartments even more. So in a tight market like Huntsville, where the occupancy rate is 97, 98% anyway, it's going to make this an even more attractive market from an apartment investment standpoint.
Yeah, and the demographics, it's one of my favorite charts to look at because it shows that, so we got low inventory now, but millennials have been the largest demographic in American history, and they're just now reaching the highest, as far as number of millennials, the peak age for buying a home, first-time home buyers. They're just now reaching that. Which just means that it's a lot more folks that are in the pool, yet they're not buying because of affordability or interest rates. But right behind them is Gen Z with even more people than it's an even larger demographic than millennials, the previous record. And the oldest of Gen Z is 21. So they're like barely dipping their toes in the housing pool. That's like a surge of new demand coming to the housing market, which bodes well for long-term projections for landlords, whether you're going to keep or just stay in the market and recycle your equity into new assets. So is there any other factors that you look at to maybe counteract that? So I'll preface here, and I know I'm running against time. Ray Dalio, I don't know if you've read his book, but so he'll look at his argument and see the data, but then he goes and says, why is that wrong? And it doesn't mean that that's wrong, but he wants to figure out and do everything he can to figure out if that's wrong, what would make that wrong? So is there anything that could make, whether it's a low inventory or strong demand, is there anything that you see out there that maybe could or you have to look at to see if you're on point?
Well, I think like Sarah said, right? So one of the things we closely look at, given that we focus on the multifamily space, is new permits. Like how many permits have been issued in a market, how many units are coming into market, and what's what they call absorption rate? Like what is the capacity of that market to absorb those units? And in the markets that we operate, we specifically look at markets that have either low inventory, and even the projected permits in the next 5 years, 10 years is relatively low. In fact, the number one issue in some of the markets we operate is having enough housing, right? So if you pick the right markets, there's a lot of let's say headwinds that you can face, right? As opposed to a market where you have a lot of units coming on board, which is going to see a huge sort of slump, if you will, or drop in the demand. So I guess it's all about identifying the right markets, buying the property right, and also depends on what's your the whole time frame. Our business plan is to hold the properties between 3 to 5 years. We tell our investors, look, it may go, given the market cycle that we're at right now, it might go into 5 to 7 years if we need to hold the property. But as long as it's cash flowing and you're getting a decent return on your investment, from an investor standpoint, that mitigates some of the risk.
Love it. All right. Any final thoughts there before we close out?
No, like your other guests have said, don't listen to everything you hear on the news. Do your own due diligence. Look at other sources out there. Speak to sponsors, and see what they have to say, and then make the ultimate decision.
Love it. Thank you very much, Percy. Look forward to having you on again. And thanks. Take care. All right, Ben. That's a wrap. It was really good. So had some good perspectives. If you didn't catch this whole show, it's on our YouTube channel. Also got on LinkedIn. If you got the link from Facebook, unfortunately I can't live stream Facebook right now, but you can catch it on YouTube. And you can also, if you're in the Houston area, you can catch me live next Tuesday, September 13th. We'll be out at a local event in Houston, live in person. It will be live streamed for anyone who is not in the Houston area. Ben, I think you're going to be there too, right?
Absolutely. Anytime I get to get together with you and our community with Invested Agents, Invested X, always excited.
Yeah, so it's an event we did a few months ago. We did a couple times. Took a break over the summer. Went really well, but it's definitely a good opportunity to mix and mingle, shake hands, get to see some other real estate professionals and investors. But we're going to be talking about multifamily investing. I've got a couple folks that are going to come out, Q&A, get a chance to ask your question. So be sure to, if you're not getting to my emails, shoot me over a DM on Instagram or Facebook. Happy to add you on, or just go to the website, investedagents.com or investedx.com, either one of those, and get connected. So thanks, Ben, for co-hosting this since Jamie couldn't join us. Just lots of little thoughts here. Ben, rockstar real estate agent in the Houston area, team leader, and he's worked with a lot of the super, super highly successful real estate investors and professionals in the Houston area. But now he's running a rockstar team, doing well. So appreciate you moderating this, and look forward to seeing you out next week.
Absolutely. No, it was great. So tons of great information. Definitely go back, rewatch the broadcast, share it, like, share, comment, subscribe. And yeah, just grateful for the opportunity. Thanks, Chris.
Love it. Thank you.